Eurobond issuances, recent Eurobond issuances by Nigeria. I mean, the government is also still likely to tap global markets next year for more Eurobonds. So the impression you get is that, look, as reserve levels continue to rise, I mean, they cross 40 billion. I suspect is that the sense we get is that, look, there's going to be more upside for the central bank to sort of try and ensure that that improvement is reflected in the naira. So you actually see scope for an appreciation. However, the second half of next year, you have most foreign investors will start to repatriate out of Nigeria because you have the 2019 elections in early February. So you generally start to see a bit of foreign investors trying to pull back. And so that would sort of drive a currency weakening in the second half of next year.
But do you think, from what you hear on a daily basis, from traders' perspective and you analysts' perspective, you think we have enough liquidity in the market right now for the central bank as the chief supplier to begin to pull back a little bit and allow this market fly on its own?
Well, I think the central bank is always very cautious about letting the market completely let go. So what I think you see is they will sort of take signals from the market. So if there's a lot of supply, then they will perhaps reduce their sales. I think also let's also look, as you said, the whole thing is a gamble. So they will always still be they always still want to still keep their hands not too far off from the button, from the brakes, from the push button. So I don't think the central bank is at that level where they will feel. I think let reserves go to a number we've heard is a $40 billion number. Let reserves cross over that number. Then we'll
maybe
perhaps
50, maybe 60.
60.
I'm highly ambitious. I'm highly ambitious.
So I think over 40, sort of a threshold. I mean, that will translate to roughly 10 months of import cover. What that will mean is that maybe they will be less. They could pull off their hands from the brakes and allow more markets sort of determine.
What do you see as the key fundamentals for the FX market in 2018?
Well, central to that, first things first is the oil price outlook. I think if we see a sudden sharp decline, I think that's going to change perception. But fundamentally, we think you're going to see oil prices remain supportive of the currency. Over the second half of the year, I mean, central, as I said, is the political clouds start to come into play. Then people start thinking, okay, I think it's time to sort of leave Nigeria. You also find a bit of Nigerians as well also trying to convert dollars to...
If they leave, if they pull back, if the foreign portfolio investors pull back on their currency holdings, on stocks and fixed income, will this have any dramatic impact on Naira-dollar relationship?
We think yes, but again, we think that the central bank has the ability to sort of stem it or stem the rate. So we're looking at Naira closing the year maybe closer to 370, 380 around
for 2018.
Levels for 2018. Yeah, around those levels. Just because again, as I said, you're going to see most of that selling pressure come in the second half as everybody.
Second half of next year, some sell pressure on the Naira. On the Naira for the dollar.
For the dollar, yeah.
Again, with the outlook on the U.S. interest rate. Well, So how do I profit? Because let's bring this out. How do I profit from the FX market next year? Should I buy dollar now? Should I go short on the Naira? Is it too early? Should I go long? Should I start going long on the dollar and start going short on the Naira?
Again, I don't think moving from 360 to 370 is anything that would make anybody want to is a significant
to offload this dollar on the street.
To offload this dollar holdings, given where we're coming from again. So I think fundamentally the central bank has the firepower to be able to keep the currency. I think let's not rule that out. They now have the firepower, unlike in the last 2 years when reserve levels had dropped significantly. Now they have the ammunition to be able to keep the currency within any range. And of course, as we've seen, they also have other policy tools they could easily deploy. They could try and shrink Naira liquidity as they've done for a significant part of this year. They could introduce all forms of curbs on certain classes of import items to try and just sort of moderate or reduce the impact.
But again, if you also have one leg of your research in fixed income, so if there's a bit of a pullback in the election, the year to the election, which is 2018, do you think this will have some impact on some portfolio and asset selection?
Well, I think what we think is that, so in the last couple of weeks, we've seen interest rates come down significantly, particularly short end, because once the central bank stopped issuing almost, the liquidity buildup we've seen has just forced a lot of people staying short because most people don't see, given where inflation is, most people feel that, look, interest rates at these levels, negative real returns, it's not the level for me to, the interest rates, fixed income is not a good asset. So you find a lot of investors staying short, thinking that, look, you're going to see some pressures further down. We think that over the second half as well, as you find a lot of selling as well, you're going to find increasing a lot of investors moving to the short end of the yield curve. The interplay between that and what the central bank does with regards to easing. So the central bank has consistently, I think, they are looking at inflation declining in the first half of next year to single digits. That patterns out. What that suggests is the central bank is likely going to start easing at some point in the second half of next year. So the interplay between that, we think, is that you see easing, a lot of investors staying short. You're going to see the short end of the yield curve depress significantly, and so you see prospect for first flattening of the yield curve and then gradual normalization of the yield curve.
A quick one, and to wrap it up, are you looking forward to swaps on FX, options, and hedging in 2018? Do you think this will come? Would you want it to come?
I think for again, investors should always use you don't just take. We don't advise people to just take positions just for taking positions.
Full exposure.
You have an underlying need. So if you're foreign investors and you brought in dollars, so you want to hedge that risk, yes, you can, but not just for the sake of speculation. You must hedges, and that's what the rules are. Is that you hedge based on you must have an underlying liability. So whatever it is, maybe you're receiving payments in USD or you're trying to make payments in USD. That's what you're trying to hedge against, as against just taking. I don't think
both the treasury managers and the FX traders would want to see more derivatives to allow them play this market a little bit, reduce the exposure over time, looking at the local and external development.
I think, yes, having derivatives, because what it helps do is it helps prevent a lot of front loading of demand. So why do people front load demand? They front load it because they are afraid that the rate is going to go outside their range. So in most advanced markets, you have that institutional means for people to hedge that volatility. And
central bank will be interested in that. They don't want anyone front loading.
Yeah.
Because even though we have $40 billion, it's still a little bit soft. We don't expose all of that to the FX market. We have a lot of things to get. Wale Okunriboye, who is the in charge of fixed income and FX research at Ecobank, Nigeria. Let's come back after the break. Then we go into the commodities power play in the week leading up to Christmas. Well, that's the conversation after the break. Stick around.